So we know the US is in a perpetual debt crisis. Over the last 2 years, the government has been borrowing money in increasing amounts to keep the music going. As long as you keep deficit spending high, you can postpone a recession indefinitely. And that's why the 2023 crash didn't come to pass. But what if the US Treasury suddenly decides to do a U-turn? What if the amount of debt issuance starts to drop? Well, we might be on the brink of a massive U-turn by Janet Yellen that has serious implications for the US economy. In a shocking twist of events, the US Treasury has cut their quarterly borrowing estimate down to $760 billion. And for the subsequent quarter, Yellen predicts a borrowing of only $202 billion. That is a big collapse in bond sales compared to the same quarter last year. Almost $730 billion was borrowed. So this is a big drop of over $500 billion, half a trillion. So why is Yellen suddenly cutting back on borrowing money to fund the US government? This is supposed to be an election year and two hot wars are still being fought that the US is moving to fund. According to the Treasury, the smaller borrowing need was driven by a higher projected net income and having more cash on hand. But here's the interesting part. Yellen declined to offer a breakdown of this improvement in cash flow. What they want us to believe is that the US economy is doing so great that the taxes coming in this year is going to shock everyone. It's going to cover the borrowing gap from Congress. And sure enough, the markets love this news. We saw stocks and bonds rally up with the S&P 500 nearing a record 5,000 points. What the Treasury is trying to do is to control the narrative because the biggest fear they have is a debt crisis spiraling out of control. Almost immediately following the announcement, bond yields started to collapse. The 10-year yield went from 4.1% down to 4.07% in a matter of minutes. A 30 basis points crash on the long end of the curve isn't normal. This was a deliberate move by Janet Yellen to restore confidence in the economy. She wants us to believe that the US is still fiscally sound. When you decide to sell fewer treasuries, you are influencing the supply and demand of the market. By selling less, Yellen is driving down the supply of US bonds. She's doing it in a period of chaos where the dollar is rising and geopolitical chaos is all around us. She's making the remaining supply of treasuries more valuable, so buyers would crowd into the markets, bond values will go up, and bond yields will drop down accordingly. So, why borrow less money? If you issue more bonds, you can goose up the economy with more spending, and the GDP numbers will look fantastic. After all, Bidenomics is taking the credit for the big bounce in retail sales in December. If I were Joe Biden, I'll keep the Kool-Aid flowing endlessly and keep the zombie economy chugging along. I want to win my re-election, right? But there are bigger reasons that require bond yields to desperately fall. The biggest threat the US faces today isn't Russia, it isn't China either, but the national debt itself. Since President Biden took office, he's on track to borrow more money than even Donald Trump. Under the Biden administration, US debt has exploded. It has gone from under $28 trillion to well over $34 trillion today. In 2023 alone, Biden borrowed $2.6 trillion. There weren't any lockdowns or national emergencies in the US, but the debt still flew to the moon. There will be serious repercussions. When you borrow tomorrow's money to spend today, you are bankrupting future generations. How fast this bankruptcy happens boils down to one single variable: the interest rate at which you borrow. Anyone who ever bought a home knows how important locking in a low interest rate is, because after 30 years, your total payments could snowball to an insane level. Because the US Treasury kept issuing a ton of bonds, especially on the long end, the debt servicing cost has started to skyrocket. It has doubled from 1.4% to nearly 3% within 24 months. And this pushes up the national debt towards unsustainable levels. And it's not just a high interest rate that's the problem. That's bad enough because the Treasury loves to borrow on the long end of the curve. This pushes out the time to maturity. In other words, the higher interest payments will last for much longer. We can see a disturbing trend since 2020. Not only is the average interest rate heading up, the average maturity has also gone higher. It went from 5.2 years to over 6 years. It's like taking out additional years worth of mortgage. You end up paying more through longer interest payments. It's not rocket science here. The US economy is debt based, and this means the volume of debt has to expand continuously to keep the wheels turning, or else a default will happen. The ultimate measure of a nation's ability to pay off its liabilities comes from its debt to GDP. As of today, the ratio has gone above 121%. We should sound the alarm bells. The entire level of debt is more than the nation's productive output. Let that sink in, right? By reducing the amount of bond sales, Yellen has admitted to this problem. She can't afford to borrow more money by selling long term bonds. It will lock the country into a vicious debt spiral. If investors don't believe the US government can pay the interest payments, they will demand higher returns, which in turn forces the unthinkable. Either the Federal Reserve steps in and they print money to inflate the debt away, or taxes on US citizens go up to pay off creditors. It's either an economic collapse or massive inflation on a global scale. Choose your poison. However, the national debt is only one factor. It's a big one, but it's not the most immediate danger the economy faces. When you run an economy based on debt, you need low interest rates to keep things chugging along indefinitely. Since the start of the year, business loan growth has stalled, yet remains stagnant at $2.8 trillion. If corporations aren't borrowing money, this is a very serious problem. It could lead to economic stagnation or worse, a recession. The US Treasury is competing with the real economy for money. Yellen borrowing more money keeps rates higher for companies because they have to fight harder with the US Treasury. That is the risk-free rate after all. Companies in the S&P 500 have over $100 billion in corporate debt coming due this year, with an average interest rate of 2.8%. If a company refinances, they'll be doing it at 6 to 7% easily, which is double the original burden. When it comes to interest rates, we all believe that the Federal Reserve controls everything, right? When they hike rates, everything else goes up, but that is only partially true. The Fed controls the short end of the curve, your 1 to 6 month treasury bills at most. But beyond that, the US Treasury has more control because of fiscal policy. When they borrow more, it drives the cost of capital higher, which is pushing many companies to the brink. According to S&P Global, there will be a further collapse in credit globally, where 40% of issuers are at risk of downgrades. In other words, there is a chance of repeating the spree of corporate debt defaults back in 2023. By spending less in the debt market, Yellen, she's sending a clear message that it is safe to borrow now because we aren't going to push yields higher. The longer we stay at higher rates, the bigger the chances of something going wrong in the economy. It's not just the Fed but the US Treasury that controls the bond market as well. And with the latest JOLTS number release, it looks like interest rates might be staying higher for longer. In a shocking data release, US jobs openings has risen to a 3-month high. It came in at 9 million vacancies, beating the estimates by almost 300,000 jobs. In addition, the number of quits dropped to the lowest level in 3 years. So businesses seems to be hiring more even though fewer people are quitting their jobs. And this is where good news becomes bad news. Because the economy still looks resilient, the Federal Reserve could be forced to push back the March rate cuts to Q2. And that, of course, isn't good for the US economy. One could even speculate that the US Treasury already knows this, so slashing their borrowing now is a strategic move to counter the Fed's delay. However, there is a black swan risk of Yellen borrowing less money, and it's a move that could lead to lower consumption across the economy. Now, just recently, the Q4 GDP numbers came out for the US, and it was unusually strong, but you quickly see why this is the case. From Bloomberg, US GDP grew 3.3% last quarter, capping unexpectedly strong year. While other Western countries in the G7 are starting to collapse, the US seems to be the only member with exceptional growth. Consumer spending has increased by 2.8% across goods and services. Looking at the numbers, we can see it has surpassed expectations, defying calls for a recession. Estimates put Q4 GDP at just 2%, while the actual print came in at 3.3%. The same for personal consumption as well, an estimate of 2.5%, but the actual growth came in hot at 2.8%. The reason they give is durable job growth and falling inflation, and they could be true, but it's not the whole picture here. Sure, US GDP has gone up, but something else went up at the same time: government borrowing and spending. During the same period in Q4, the US Treasury borrowed $776 billion from October to December 2023. That is 40% more than what they borrowed back in Q4 22, which came in at only $550 billion. So more money has been borrowed last quarter to goose up the economy. When the Treasury borrows more money, it goes to the US government, which spends it in the real economy. It's money used to pay salaries, hire more government workers. It's money also going to the military industrial complex as well. And all this affects the GDP growth of the economy. They are joined at the hip. And here's a shocking number that many people are still unaware of. 36.2% of US GDP comes directly from government spending. Annual GDP came in at 27.6 trillion, while the government spent $10 trillion dollars, and that's over a third of the US economy that's powered by government spending. So what do you think might happen if the Treasury borrows less and government spending starts coming down? If Janet Yellen borrows $1 trillion less for the year, GDP could fall by over 3.5%. And this is what addiction to deficit spending really looks like. The moment you stop goosing up the economy, the withdrawal symptom could be a recession. Even though interest rates have been rising and staying at 5.5%, US GDP has been staying strong quarter after quarter. Since the technical recession in 22, the entire economy has been propped up by huge deficit spending. If Yellen decides to not borrow more money, you can see how this poses a big problem. This will affect consumption in the US, job growth might stall, which could feed into a loop of people spending less and less. While the national unemployment rate is at 3.7%, near the lows in many states today, unemployment has gone up. In 13 states, unemployment is at 4% or more, the highest since December 2022. The jobless rate is already growing. By cutting deficit spending now, by cutting government spending, Yellen would increase unemployment and consumer spending as well. And that could in turn affect the earnings of companies in a market that's priced for perfection. Everyone expects the US consumer to keep spending and spending and spending, and for companies to keep raking it in. But that assumption fails to account for an event where the US government suddenly decides to borrow less. And here's the $1 trillion question or the $1 quadrillion question. Will the US economy fall into recession because of this? It could happen, but the immediate danger lies in stock prices going forward. We are in a season where companies are trying desperately to justify their huge valuations. Tesla, for example, fell by 10% after their disappointing earnings report. And this is what happened when earnings miss and the stock market is at record highs. Now project this across the US economy. If government spending falls in a big way this year, we could see multiple companies miss their earnings. When you have a market priced to perfection, expecting spending to go up and never come down, any deviation from the narrative might be enough to crash everything. According to JP Morgan, the top 10 US stocks are extremely overpriced. They are reaching levels just before the dot-com collapse in 2000, and this shows the level of expectations or bullishness the market has in US equities. So Yellen might be the straw that breaks the camel's back. By borrowing less, she drops bond yields, allowing the real economy to breathe more. That might be true, but because the market keeps rallying higher and higher, it sets up a big earnings disaster down the road. Now, the only way to avoid this is to swap it with another. If the Federal Reserve comes in, slashes rates 5, 6, or even 7 times this year, then yes, stock prices could stay high as the Treasury reduces their borrowing. But by doing this, they will be swapping the current problem for a bigger inflation crisis down the road. But let me know what you think. Can Yellen really stop borrowing money, or will she U-turn and keep the party going? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.